All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. No new entry triggers here this afternoon. It's pretty dry out there. We do see 3-7 crossovers to the upside on Schlumberger, CSX, which are on the watch list, Johnson & Johnson, which is on the watch list, but no triggers there with them. Most of them are coming off of lows. J.P. Morgan also has a 3-7 crossover, and just because they're coming off of lows doesn't mean they're not, they don't have a potential to trend. It's just a lot of times it looks a lot more like this back here in May, which we saw. We saw the 3-7 crossover. We didn't get a trigger on that, right? But then we get a higher low. We do get a trigger and a chance to play. Only we played it with Bank of America rather with J.P. Morgan, but they both did the same thing. So no new trigger there here with J.P. Morgan or any of the others. Now I am just a touch early here, but I don't think things are going to change all that much. So let's go do what we have to do here for the challenge. We have Visa, Microsoft, and Micron. Let's get the values in here. 225 on Microsoft here. Not a fun day for Microsoft. Let's see, 284 for Micron and 435 for Visa. So Micron's picked up here. Got a little mid-morning upgrade come in on it, so that definitely helped it. But you can see between the three positions, we're up about $600. So nothing too dramatic either way. But Microsoft is hitting its time stop, 8:22 p.m. We entered the stock at 137.99. The stock is now 137.30, so we have both the option and the stock against us here for Micron and the implied volatility. So never a fun combo. So let me pull this. Let me pull the broker account over here, and I'll exit. Microsoft here. Let me jump in. There we go. And let's just pop this off here. I'm just going to do a market order on it. 226 is the exit on that market order. So out of Microsoft at 226 here. And yeah, I do think it's worth a hold, but not something I'm able to do here with the challenge as it sits. Okay, but yeah, it is something I do think goes higher. I think today is a little bit of a one-off there, but as far as challenge goes, we've lost the odds in our favor, so moving on out. So 226 was the exit price. Trade closed. All right, trade closed and trade date here 8/22/19. So Microsoft not treating us real well the last two trades here. In fact, I think that probably puts Microsoft as our worst stock of the challenge here. It's not our biggest loss, but I believe we had a gain earlier in Honeywell. No, we didn't. Only one with Honeywell. So Honeywell and Microsoft are two for the challenge here so far. All right. Visa and Micron, neither at their green stops, and both of them are trading in the green here, and with both the stock and the option. So nothing to do here with those, and so we'll continue to hold them. Have had a lot of questions come in about implied volatility, and so I want to go talk about it one more time. All right, I'm going to talk about it a little bit differently than I have so far, and hopefully this will be the last I talk about it here. I know sometimes the more I talk about one specific topic, the bigger it feels, but this is a topic that it's integral into every option trader's everyday action. It's something we've been dealing with challenges for years. It's not going away, and it's not something that is this, light bulb, wow, what is this? This is crazy type of a thing. This is mostly for just understanding how options work, and understanding the more you understand about how they work, the better you can kind of have in terms of your analysis of your risk and reward as you go out and make new trades. So let's go take a look at it. But before I do, Chairman Powell on tap here tomorrow, and not a lot to say about the market today. Not a lot of major action. Market has been a little bit more volatile today than what it was yesterday and the day before and the day before that. But we even talked about that this morning. S&P futures were more volatile overnight, so we're probably going to have a few more swings here during the day, and that's what we have seen. And it's uncanny how well that works. You look at how volatile S&P futures are overnight, you're probably going to get that same level of volatility during the day in terms of just pure price movement. Now, it doesn't necessarily predict direction, but in terms of pure price movement, that's what you'll get. So let's go take a look at Micron, right? And let's go talk about Micron for the challenge. And I took some of the data and I threw it over here into another sheet, and I added some columns, right? I added some columns here, and we can see with Micron we're up $840, right? Given what the price was a few moments ago. Okay, great. On a $3,000 position, that doesn't feel too great, right? Come on. We basically, the current price of the stock is what, $45, right? 45.08. Let's see here, 45.04. And the stock price that we got into was $43.63. So $45.04 is the current price, and we got in at $43.63. So this stock has rallied $1.40, right? $1.40, which is not a full ATR yet. But, if you've traded Micron a bunch, you know that $1.40 on a monthly option, typically is going to yield, somewhere around 40 to 50% gain, right? And we're under 30%. Well, we're 25%, somewhere around there, in terms of gain. Okay, so why? What is driving that? Why is it not keeping up? Well, it's something we are not only seeing with Micron, but we're seeing with all options right now, almost all options right now. And it is nothing unusual. It's nothing dramatic. It's nothing, oh, wow, I've never seen this before. This is something that happens frequently after market pullbacks or periods of fear have come into the market, right? And we talked the other day about an option value, right? The option value is a function of a variety of factors. Stock price, right? Stock price, time, dividends, interest rates, right? We can observe all four of these. When you go out, we can say, okay, what's the price of the stock? Okay, how much time does this option have? All right, what's the dividend on the stock, and what's the interest rate out there in the market? And boom, we can get our option value. But if we take these four factors, it will not add up to the option value, right? There's always going to be a difference here. But there's not an observable variable to go out and look at this difference. This is what traders call implied volatility, right? It's a lot of times people lump it into a time cost, but it's not the same thing, right? It's that additional premium that option sellers demand to hold the risk of having the option. And if a stock is flying all over the place, or the market is incredibly uncertain, and things are just going all over the place, option traders are going to demand a bigger premium. When things are calm, when things are flat, when nothing's going on, when we're in a low volatile time of year, option sellers aren't requiring as much of a premium. So the option value will be lower, the implied volatility will be lower. They call it implied because you can't go out and observe it. You can only calculate it. We can observe what the option value is, And so we take the option value, we subtract out the stock price, subtract out time, dividends, subtract out the interest rate, and that leaves us with implied volatility. Okay? When it comes to implied volatility, just keep this in mind. As implied volatility goes up, the option value rises. Now, depending on what option you have, stock price, time, dividend, interest rate, they could offset the implied volatility change. But when implied volatility goes up, and everything else is equal, the option value increases, right? And vice versa. Okay, vice versa here. All right. The tendency in the market, the tendency is as a stock rises, option implied volatility shrinks or falls. Think about this. Why would that be the case? Right? As stocks are going up, do they tend to go up real fast or a little bit slower? You know, there's this old saying in the market, stocks take the stairs up and the elevator down, right? They're slow rise and quick to drop. And that's not the case everywhere, but that's a tendency. And so as a tendency, as a stock rises, the option implied volatility falls. And so as a stock falls, the option implied volatility rises, right? So vice versa. Okay. That's the tendency. When there's a big event, such as earnings upcoming, the implied volatility is high. Why? Because investors know, or option sellers know, that, hey, there is a greater risk of a strong move that can happen ahead of with earnings. So they'll be willing to sell you an option, but they're going to charge you extra premium. That extra premium can only be quantified as implied volatility. So this is the tendency. This is how it kind of, plays on out. It's one of the reasons why we can actually have a stock. You can own a call option on that stock, and you can see that stock go down, and the option barely move lower. Now, it'll most times move a little lower, but sometimes you'll see and you'll go, wait a minute, I should have lost a lot more than I lost. What's going on? Well, it's typically a rise in implied volatility, right? And then what will happen is the next day the stock will recover some of its losses, and then the option value is not going to go up. So you have a call, the stock value recovers half of the prior day's losses, but the option value doesn't move. Why? Well, that implied volatility gets sucked back out. And so it looks like, oh man, I just rode this rally and it did me nothing, right? And we see that happen. Now, can we go and quantify all of this? We can. And I'm going to show you how. We're going to go do it here for Micron. And there are several ways to go do this. This is, just one way. This isn't necessarily the best way or the only way. And I do not do this for every trade. I do not do this for any trade, right? This is not something that I go out and, figure out and go, well, how's it going to affect? Why? Because with a quick look at the options, you can say, all right, you know what? I have about 10% implied volatility risk. I have about 5%, right? You know the overall environment. And so it's not something I actually do. I guess if I were a little more number-centric, maybe I would. But it's also not one of those things that is so exacting that it matters all that much. And if you're very exacting when it comes to each and every number and decimal and all of that, and you want everything to add up, this is not an exercise to go through when you're trading because it'll drive you mad. But let's go take a look at it for Micron. We got into Micron on 8/16, right? On 8/16, and when we got into Micron, that position, that option, had a delta, theta, and vega. What is delta? Delta is how much the option value will change per dollar change in the option. Okay? Stock goes up $1, how much is the option value going to increase? Stock goes down a buck, how much is the option value going to decrease? Okay, and we're talking about a call in this case. Theta is time decay. How much money are we going to lose each and every day due to theta? Vega is the implied volatility. Now, this tells us how much our option will gain per 1% move in Vega or in implied volatility, right? So the Vega is actually just showing the change. Anytime you look and you see a Greek delta, theta, Vega, think of the word change. That word change should immediately come into your head because that's what it's talking about. It's talking about the change in the option per dollar movement in the stock. So change per dollar, and then you can, you got them down. They're not that complicated there. But let's start with Micron, and let's go look at what these variables were when when we entered the position. Now, Thinkorswim has a function in here called think back. Okay. And what it can do is it can go back and it can look at different periods of time and show you what option values were, what some of the delta, gamma, theta in the Greeks were, and you can go back and see it. All right, so let's come in here. We're going to start with delta, and I already have this set for 8:16. Okay, now this is at the end of the day, so yes, it's not going to be exactly right when we got in. What did it look like? But it's very close. Okay, and we did the 20th of September, 44 calls, and at this point, the delta on it was 50 cents. Okay, delta was 50 cents. So let's fill that in, 0.50. All right, let's go back. Let's get the theta. Right, what's our time decay? Time decay is 3 cents. All right. What is our Vega? It's 5 cents. Okay. All right. So we have theta 0.3, and we have Vega, which is a 0.05. Let me get that correct here. And theta is 0.03. Okay. Now, our actual implied volatility. Right? In fact, let me just come in here. We'll insert it. What was our implied volatility? The actual number was 47.4. Okay? 47.4. Great. So what do we know? We know that our option is worth $2.25, a delta of 50 cents. So every time the stock rises $1, we're going to gain 50 cents on our option. But holding this option is going to cost us 3 cents a day. We can just say, you know what, that's our cost. 3 cents a day. We hold this for 10 days. Our option value is going to go down 30 cents. Price of doing business. All right? And, that theta is in every option. The Vega, though, this is, while the theta is something we can look at and say, well, yeah, we're going to realize theta no matter what, right? We can't get away from theta. Vega, we don't know if it's going to help us or hurt us, right? We don't know. Is the implied volatility going to go up? Is it going to go down? We can speculate on it. But if the implied volatility goes up, we're going to make 5 cents per implied volatility point. The implied volatility goes down, we're going to lose 5 cents per implied volatility point. We're playing a call. So which way is implied volatility most likely to go? Right? The tendency is that the implied volatility will go down. Okay? Well, let's see what's happened. Let's come into today's numbers. Right? Come into today's number here, and we have Micron, and we have a theta now of 4 cents. Okay, right? A theta, it's actually increased here. That's today's number, right? 4 cents. What is our implied volatility? It's 44.3. Interesting. 44.3. It's dropped, right? In fact, let me center all these numbers so they're lined up. Okay. What's the delta on the option now? Well, the delta on it, 61 cents, and the theta, or time decay, is 4 cents. Okay. And Vega is 5 cents. So what have we seen in the numbers? We have seen that the time element has shifted. It's costing us more per day to hold it. But the delta's also increased. We're now making 60 cents per dollar move. And the Vega is the same. But look at how the implied volatility has dropped. The implied volatility has dropped by what? 3 points, right? So that nets us a loss of 15 cents on our option. That's what the implied volatility nets us. What about the theta? How long have we had this? 5 days, right? So that logs us another 15-cent loss on the option. So between theta and Vega, we have lost 13 cents, or excuse me, 30 cents. Okay. If we come into the delta, right, and we look at the original number of 0.5, right, and look at where the stock price is, right, we've gone from 43.63 to 45.04. So the stock price has gone up $1.40. So we should have an appreciation here of what? 70 cents, right? That should be our option value appreciation. So in all, right, we should have 225, should go up by 0.7, so should go up to 295. Now we're going to lose our theta, now we're going to lose our Vega, and that drops us down to 265. 265. Well, let's go take a look. What was our option value now? 285. So we're actually a little bit ahead, right? We're a little bit ahead. You'll notice they're not coming out perfectly. Big reason is the delta. Well, because we did not bring in gamma here, right? Gamma is the rate of change of the delta. The delta actually has a rate of change associated to it. We didn't calculate that in, but that's where the extra the extra 15 cents is. The other 5 cents is probably in the spread, right? So, but we can see what this move in implied volatility has cost. Can you see why I don't go through and calculate this, right? I don't go through and calculate. I don't waste my time. I know what? I know, okay, per dollar move in the stock, our delta is going to be this. And I know that delta is king. Delta is king. If the stock moves and moves abruptly, Vega, theta, they're not even going to be felt. Right? How many challenge trades do we have where, the theta and the Vega, weren't even felt? GLD, Under Armour, Intel, they weren't felt at all. Why? Because the delta just absolutely consumes them. Delta is king. But when delta's not kicking in, or when delta is slow, these two factors start to feel pretty big. You start to look and you go, man, my stock gets up 20 cents and my option is down. Well, yeah, 20-cent move in the stock isn't enough to overcome that day's theta and Vega. When you're playing calls, and you have the stock go down and implied volatility goes down, that stinks. That absolutely stings, right? Most times when the stock goes down, implied volatility goes up. But when we go into a market like this, where the relative rate of change has actually slowed, so yes, you can see your stock go down. You lose a little delta, and you lose some theta, and you lose some Vega. And it's just a reality of the situation and the risk of the situation, right? You say, well, it's not fair to have these elements. Well, think about the person trading the other side, right? The person who sells you the option, right? They're taking on a huge risk. they deserve to get some of this, right? People oftentimes turn to selling options because they can take advantage of theta and vega rather than have it go against them, right? But what do you lose? Yeah, you have theta and vega going against you, but now delta, who is king, stings really bad. Stings really bad because when delta goes against you, you're in trouble. Okay, you get hit pretty darn hard. So, option sellers, they say, well, I'll go way out of the money. That way delta is minimized. And great, they can do it on a high probability basis, right? Where they're right 85, 90, 95% of the time. But if you're wrong 1 in 10 times, you've blown away all of your gains that you had on the other 9 trades. But this is delta, theta, vega, the Greeks in action when it comes to Micron. The Greeks have been in action when it comes to our Visa trade, right? We could go through this same exercise with Visa, and it'll be a little more dramatic here in terms of the theta and the vega loss. But it's just a reality of the situation. It doesn't mean we're going to have a vega loss tomorrow, right? We are going to have a theta loss tomorrow, absolutely. But, you say to yourself, okay, we've lost 15 cents on vega. Let's say we're going to lose another 15 cents on vega, but the stock's going to rally another $1.50. Are we willing to do it? Of course we are, because delta's going to overcome vega. But if we're wrong and the stock goes flat, delta's not going to overcome vega, and we're going to feel it. Right. So, yes, can you get around not having vega exposure in the market? You sure can. But then what are you doing? Are you trading options? No. Right. So delta is king. Just keep that in mind. Delta is king. But when a stock doesn't move its average true range, delta struggles to overcome theta and vega. And that is one of the big reasons that for the challenge, we put the algorithm together the way that we did. We are looking for higher probability moves where a stock can move 1 average true range, 2 average true ranges. It's not about looking at Micron's chart and going, I wonder where this stock goes tomorrow, right? That kind of, that type of element. We can look all day and go, well, Micron, is it going to go to 45.22 or is it going to go to 45.84? Is it going to go to 44.20? Where's it going to go? We can argue about price targets and everything, till we're blue in the face. But the reality is what we're able to do with the algorithm is say, okay, the probability of trend here is high. And defining the probability of trend is saying, does it have a solid potential to move 2 average true ranges? Because we know if it moves 2 average true ranges, it's going to overcome any theta effects. It's going to overcome any vega effects. The delta will be king, and that's what it is looking for. But we also know that when the trade doesn't go our way, when it goes sideways, the delta, the king, has left the building, and we're left with the poppers, theta and vega. Okay, so hopefully that helps. Put a little bit of perspective there on theta, and kind of how that goes into action. It affects every single trade out there in the market. Right now, we are just seeing some vega drops. One way you can kind of look at the overall market vega is looking at the VIX. Now, the VIX doesn't necessarily translate into each option for each stock, but when the VIX is at 24, right? When the VIX is at 24, what's the implied volatility? Okay, so I go out and buy some weekly SPY call options right here, and the next day the market rallies 10, 15 points, and the implied volatility drops dramatically. Am I making any money? I mean, I nailed the bottom, right? I nailed the bottom. My option should go up. Nope. And I've been there. I've nailed the bottom and seen my option actually go down when nailing the bottom. And it's one of the reasons why when you look and you see my challenge trades, I'm not trying to pick tops and bottoms. There's not a the only value in picking bottoms is to feel really good. When you pick a bottom, it feels so good. But typically, you need 2 to 3 strong moves when that happens because your implied volatility is going to go against you. And so that's you can kind of see how that plays out here with the VIX, and how that kind of ebbs and flows overall. And if we see the VIX bleed back down to lows, what's going to happen to overall option values? Well, they're going to shrink, right? They're going to diminish. Now, a lot of stocks, Delta will overcome the theta, or excuse me, the Vega in a big way, but that Vega will most certainly have an impact. Thanks for hopping on. Have yourselves a fantastic evening, and we'll talk to you tomorrow. Take care.